saving on taxes today. Yeah. So tax harvesting is a strategy, as you can see on the presentation. It's a strategy to optimize your equity portfolio by reducing taxable capital gains. Right. We all to understand one simple two, three concepts. One is capital gains. Whenever there are capital gains, that means there is capital appreciation and booking of profits, you will have taxation on that, right? So in India, what is the taxation? Right. So it includes this session will talk about tax harvesting and tax loss harvesting strategies, right? So gain and loss. There can be two simple parameters here. So how do I do it every year? Can I make some sort of changes in my portfolio in terms of gains here? Let's look at few things. So what is capital gains? Capital gains are of two types. One is a short-term capital gains and one is a long-term capital gains. We'll just name it STCG and LTCG. So in the short term capital gains, the holding period is less than 12 months. Most of us know that. And long term, it is more than 12 months. So within 12 months is short term, above 12 months is long term, right? So current taxation is 20% on capital gains. For example, if I buy something for 100 and sell it for 120, 20 rupees is my gain, and 20% of that is my short term capital gains, right? Something like that. So what is the exemption? There is no exemption limit today in India, right? So whatever is my tax gains for the year, that financial year, from April to March, I have to pay 20% of that as taxes. This is my short term, the trading I do, or if I sell my mutual funds or my stocks within a year. If I do it, suppose I buy something today and sell it after a year, right? Then what happens? Very interestingly, the taxation is lower. It is 12.5% of the gains. Now, exceeding 1.25 lakhs. Now, this is the game changer where we are trying to look at many aspects here in terms of tax harvesting. So, the first 1.25 lakhs is exempted from capital gains. Post that, you pay 12.5%. There will be examples following the next slide. So, even if you're confused, don't worry on that, right? So, just keep this in mind currently. It's short term, long term, 20% on short term, 12.5% on long term after 1.25 lakhs. As simple as that, right? So next slide, let's look at clarifying this further and how we're going to use this to offset many taxations. So, what does tax gain harvesting involve? It involves realizing gains in a low income year or splitting gains over financial years to benefit from LTCG exemption. Right? What am I going to do? I'm going to say if my short term profits are there and currently can I book some short term loss, then I can offset that. Now, when I book a short term loss, it doesn't mean that I book it, right? I sell it. That's just like a book transaction. I sell it and I buy it back. So I still hold the same security if I want to, right? It could be a stock, it could be a mutual fund, right? Any sort of equity. So very importantly, we are talking about equity taxation here, okay? So if you see we've just given you a few examples, right? There's an example table here of tax gain harvesting first. Now, when we say tax gain, what does it mean? So look at two scenarios we have created for simple understanding. One is the no gain harvesting, one is with gain harvesting, right? So suppose in this example, you see there's a long-term capital gains of 7.5 lakh rupees, right? So my exemption for that year, suppose I booked a profit of 7.5 lakh rupees today. I can take any example. This is just for you to understand. So 7.5 lakhs, 1.25 is the exemption. So 7.25 minus 1.25 will make it my taxable gain is 6.25 lakhs. So the gain was 7.5, taxable gain is 6.25. So at a rate of 12.5%, the tax liability becomes around 78,000 rupees. So there's no sort of, getting away from this because this is all now captured on the IT backend, income tax backend, that is. So earlier it used to happen, a lot of plays around this used to happen. So with gain harvesting, suppose I'm doing the harvesting every year, okay? 1.25 lakhs, I keep booking every year as profit and again re-entering that same strategy or stock or mutual fund, right? So if I have done that and spread it over 5 years of time, 1.25 lakhs every year it's exempt, right? So my tax becomes zero. So just think about these scenarios, right? I straight away save 78,000 rupees, right? It might not happen to the full, but it can happen close to that at least. So we are splitting the gain. So splitting gains every year is important where we can look at saving these taxes. And this is one more very important point. This is totally within the framework of the government rules as well. And there's no one to say that what you're doing is wrong, right? Okay, or it is not within the law, right? So yeah, let's look at the next slide. Let's look at next examples. Okay, now so tax gain harvesting realized gains effectively. Now, how do I do that? We've just given a two simple example with the tax gain harvesting, with the tax gain harvesting, without and with the tax gain harvesting. So, if you see what happens, we the you know the look at this example where it says share purchase 15,000 shares of ABC at rupees 50,000 at rupees 50. Total investment is 7.5 lakhs. Current market price is 100. Say suppose we are doing it now. So uh, unrealized gain is 7.5 lakhs. Okay. This is a split of the example. So LTCG exemption unutilized will be 1.25 lakhs and 7.5 lakhs is exempt within the limit. So what happens to the tax impact, right? Look at with the tax gain harvesting, we see the last column. Future LTCG may be taxed at 12.5%. Here, no tax paid and cost base rate reset to 100%, right? So I keep resetting it every year and keep looking at booking that profit every year and re-entering that. Okay. So this is total about if it's a breakup of the example we're talking about, the long-term capital gain. Right. We'll have questions if you have any post this call as well. So just to keep you updated. Right. Okay. Next. Tax loss harvesting. Now, very importantly, equity can involve losses. We all know that, right? So how do we look at doing things in a scenario in short-term capital gains, right? Uh, See, taxation at 20% pricks a lot. Trust me on that, because equity can become a double-edged sword. 20% tax rate on your profit uh, can mean really big things, because profits and losses both are part of these this sort of investment vehicle. So loss harvesting involves selling underperforming equity investments to realize capital losses, which can be used to offset capital gains. Okay. For example, if I made a profit on 1 lakh and I make a loss of 80,000, so my net profit is 20,000, right? So as simple as that, if you think about it. So one financial year is considered as a opening and closing stage, right? What is my net profit? Okay. So look at the next point there. Unused loss can be carried forward up to 8 years. Just think about this point. Whatever capital loss I do this year, I can carry it forward for the next 8 year and offset it towards with my capital gains. So these things are really not. When we see practically we see a lot of clients have not used this at all. Could be there was a capital loss in some year, previous years, but they end up not using this offset at all, which can be a huge tax loss for the investment portfolio. Right. So we have an example table here. Let's look at again two similar scenarios to keep it very simple, without loss harvesting and with loss harvesting. Okay. Suppose the capital gains, which is short term, right, which is within a year, is 5 lakh rupees, right? And if you do your capital loss realized in equity is zero, the net taxable gain becomes 5 lakh rupees, right? What if I'm able to offset that with a capital loss which is there in my portfolio and reset it? Just look at this scenario where 4,50,000 is booked here. So the net taxable income obviously will become the gain minus the loss. Okay. So your guess is you can guess any number here. People have capital profits loss up from 10,000 to 10 lakhs and 50 lakhs also. So there's no ceiling here. Straight away your tax liability can decrease multifold times, or it can become zero as well. Okay. So
One second, just to add,
yeah.
sorry, Nirmal. Just to add here, this is actually of one of our clients at HappyWise, where we have saved this taxes for this year of 90,000 rupees. We did not want to name
Yeah.
it, but we have taken the live example for this year.
Yeah,
Yes,
correct.
please.
I mean, these strategies can help, as I said, manifold times, and we've seen it day in and day out. So I think the basic activity we do primarily in March is looking at these sort of things, what we can do at HappyWise. So tax loss harvesting, that way, key benefit here, tax save straight away, 90,000 rupees, right? So yeah, next. Well, we can put in the next slide. Yes. So the same table we put in here, how you can, how we've given you this example here of short-term capital gains, right? So look at this share purchased, 7,500 shares of XYZ at 200 per share, right? Current market price is 150. Okay, so 1125. Unrealized loss becomes 375. What happens? This is a classic example because why we said live example, this is happening right now. If you see the equity market this year from last April to current date, I mean, we have generally gone down in the sense the market has corrected almost 20% plus. Okay. So in this scenario, this plays out very well, right? Because you generally a lot of clients' portfolio have profit for short term. And then when it comes down, we have an option to offset with that with losses which are still not booked. Okay. So if I book that, just see what I can do. I can save taxes up to, it's pretty simple. If you think about this example, if I have a 1 lakh rupees loss, if I can book something, what is a booked loss? I just book it, but I might still hold that security. Suppose I have a share at 150 rupees. The same thing I re-enter, I just exit and re-enter and I book the loss just for the book, right? For the current financial year and I offset the taxes. So without with tax harvesting in these examples, we he saves 75,000 rupees in taxes by offsetting the capital loss. Right. Yes. Next. So let's sum up this before we open to more questions. Uh, Now, you might have questions as to what happens to my cost price, or my cost price becomes lower. What happens to the taxation later? There are many such things. So before that, look at these two strategies. This in two parameters: tax gain harvesting. So what is the objective there? To realize gains efficiently. Okay. So how does it work? Split the LTCG over financial years. Now the LTCG is your long-term capital gain. So if I can split and take advantage of the 1.25 lakhs exemption. For example, if you have not booked any or you have not sold any of your shares or mutual fund this year, there'll be no long-term capital gains, right? But if you bought something before a year and there is a unrealized profit, we can book at least 1.25 now, right? We might not want the money, it's just that we are selling that and could be entering again either the same security or any other security. So what does it lead to? I can also look at my portfolio reconstruction. Do I want to make changes to my current portfolio? Right? Because we keep talking about asset allocation. We keep talking about as you reach your goals, your portfolio needs to change, or there could be uh, a security or a mutual funds which we want to change due to many aspects we track. So this is what we want to do, at least look at 1.25 lakhs of long-term capital gains every year so that we can do that with zero taxes. So tax loss harvesting, offsetting gains with losses, right? So sell the underperformance, reinvest smarter, right? Uh, very simple things to do, but I think majority of the population don't do this because obviously lack of awareness could be a lack of thought process on this. So reducing tax capital gains and carry forward losses as well. See, one thing we always know, we feel that whatever my expenses, my taxation are the same because it's on the income, right? But this is the only vehicle where if I have a loss, I can carry it forward, right? The capital gains. That's a beautiful tool which should be used. Right? So, uh, to summarize, gain harvesting is about, or tax harvesting is about either the gain or the loss, offsetting the gain and making good the losses, right? At least to some extent, right? Yeah, next. So the last point before the last slide before we can open for questions and feedback. So what does it do? It tax harvesting helps improve your portfolio's post-tax returns. Slowly but surely, as we all say, oceans are filled up by drops of water. So these drops of water actually add that 1-2% slowly to your portfolio, amongst other things we can do. So review your portfolio annually to explore tax harvesting opportunity. This is the go-to thing at HappyWise. Even people on this call who are not under our financial planning umbrella should do this right away. Is one more initiative from our side, which we are going to do all day today. So once we do this, it's like gaining, people gain anywhere from minimum of 5 to 7,000 to, as we showed the example, lakhs of rupees. So we can do that right now. So wherever there's a situation, I mean, every portfolio can have either sides of either uh, loss harvesting or profit harvesting, or just looking at long-term 1.25 lakhs booking of capital gain. So these are the initiatives you should take and do it every year relentlessly. Right. So these are the points from our side. I mean, looking forward to anything you want to add, Pratish?
I think perfectly summed up. Nothing to add as such, and we would be happy to take questions
Sure.
if there are any.
Yes. Thanks for your attentive listening as well. I mean, Saturday morning, I can understand quite a dull subject, but very, very important, trust me.
Yeah.
Any
I mean,
questions?
at least we have been experiencing with a lot of our clients, we have been able to save quite a number of amount, like Nirmal said, right from about 8,000 rupees to few lakh rupees as well with in certain cases. So it is a very important thing to do tax harvesting, and we have time till 28th, 29th of this month to do this activity for this financial year. So anybody who is interested can, you know, ask us, understand how you have to do this, and you can do it yourself. Or for all our clients, we have already been doing this exercise from last few weeks.